This is episode 8 of Trading Bot Sessions, where I talk with traders who've built automated trading strategies and trade everything from stocks and options to futures and crypto. In this session, I speak with Dr. David Rhoiney, a robotic surgeon with a background in applied mathematics from the U.S. Naval Academy and general surgery residency at the University of Illinois at Chicago. David goes by the handle SurgiFi on Twitter and is an active voice in discovering what is true and what isn't regarding personal finance and investing. We covered David's background in the Naval Academy and his work as a robotic surgeon, his journey into finance and managing his own investment portfolio, challenging misleading ideas on Twitter, and his investment ideas and strategies. This is Mike Christensen, co-founder of Traders Post, and I trust you'll enjoy this episode of Trading Bot Sessions with Dr. David Rhoiney. Well, thanks, David, for coming on. Appreciate you spending some time with me here. I had some questions I really wanted to cover a little bit about your background and talk about your mission in terms of, how to really help the average individual sift through a lot of the finance jargon that's out there on the internet. Maybe you can help people understand the resources and tools that you've used to circumvent that kind of stuff. But to kick this off, start with a little bit about your background, where you're from, and what you do these days, and how you've made a foray into finance.
Yeah, I'm Dr. David Rhoiney. Thanks for having me on. I run a website, blog, whatever you want to call it, and a Substack by the name of SurgiFi. It's a really dumb name. I was very lazy. It's surgeon plus finance or surgical plus finance, whatever, SurgiFi. But I also go by Fi Surgery on Twitter. Don't ask me why it's Fi Surgery, because somebody's been sitting on SurgiFi for a long time. I digress. I'm originally from Honolulu, Hawaii. Very humble beginnings, sort of bounced around when I was a kid, including living in a car at one point, being homeless with my brother and my mom. Grew up very poor, managed to somehow survive that, play basketball pretty well, and then make it to the United States Naval Academy, where I played basketball and I ran track. Ended up becoming a cryptologist, where eventually I went on to go to medical school and become a surgeon. Now I do robotic surgery and acute care surgery. So I'm not doing too bad these days.
Can you explain a little bit more about what robotic surgery is, just for the general person here?
Yeah, so I use a robotic surgery platform I use the intuitive Vinci platform. This isn't an endorsement. And let me say, anything I say does not represent the U.S. government or my employer, but it's the leading platform right now, and I do surgery using the Da Vinci Xi platform. And basically, I sit at a console, I put the ports in, hook the arms up, and I sit at a console and do the surgery from the console.
And does that do surgery on people like anywhere in the world, or is it candidates who?
They're getting there. They're
Okay.
getting there. As of right now, the console is in the same room, but I know they're testing the capability to be able to do it in a remote location.
So the patient is usually there with you then?
Yes.
I see. And what kind
But
of
I do think
surgeries?
they're going to get to a point where they can do it where
Over
the
the internet,
surgeon's not in the room with the patient.
which is a crazy concept, because you could be one of the
Extreme.
best in the world, and now suddenly somebody in, the UK would have access to your skill, right?
Yeah. So like if you're looking for somebody like Mass Gen or Johns Hopkins to do your surgery, as long as they have a partnership with the hospital somewhere else in the world, they'll be able to do your surgery.
Is there a limitation to the types of surgeries you can do?
As of right now, no.
Really?
If I mean, it's primarily limited to the chest and abdomen and pelvis, but I mean, there's expanding instances. There's instances of people doing neck surgery with the robot. Just instances of people doing breast surgery with the robot. Those are more like loose FDA sort of clinical trial type stuff, but they're getting there.
That's crazy. Do you have any stories about the craziest surgeries you've done with this technology?
Uh, Man, I think I've done quite a few. Nothing that really jumps to mind right now.
Okay. Yeah. How many surgeries have you done robotically so far?
A lot. I'm probably well into the hundreds at this point.
Oh, that's amazing. That's
Like
amazing.
I'm definitely well over. I'm well into the hundreds. I can't tell you. I don't count surgeries. I just do them,
hmm
and I operate a lot. But I'm well into the hundreds.
Cool. Well, I know we're here to talk about finance, but you had me really curious about that. That's
Yeah,
really cool
man.
technology. So maybe you can tell us a little bit more about, your history of personal finance, but eventually getting into investments and,
Yeah.
how what that means to you today.
Yeah, man. I left high school, no financial literacy whatsoever, man. 17-year-old, I got my first check. It was like $1,500 or something crazy, probably close to $2,000. Actually, it might be a little bit more, but I took all of it, man. Went to the little department store, and I bought all the stuff that I was deprived of as a kid, man. So I bought a bunch of CDs, a DVD player, all sorts of crap that I did not need. I think I only have the CDs to account for today, right? Um, and I mean, I was making all the wrong decisions with money. I had no concept of saving, didn't really know what a checking account was. And then I got to Naval Academy, and I was just racking up credit cards, right? Because I'm the poor kid at a school where people will typically go when they're like upper middle class and their parents are legacies and they come from these successful families. And they go to the Naval Academy, which is just like an Ivy League, right? And so I get there and I'm trying to keep up with the Joneses, and I don't have any money. And so as a for basketball, we used to travel through the airport, and there will always be like these credit card booths set up, right? And so I'd
Mm.
sign up for a credit card, and that's how I get some more money. And then pretty soon, I had like 10 credit cards, right? All low balances, all this wrong stuff. And my prep school coach happened to be an advisor for Primerica, and it was and caught wind of me messing up my money. And freshman year, plebe year was like $100 a month they give you, right? He put me on an allotment, and he was like, "Look, you're not going to do this. You're going to," and he started a Roth IRA for me, and he made me live off of $50 a month, man. Like, can you imagine being a college athlete trying to go on a date on $50 a month? It was freaking terrible, man. Absolutely terrible. And so, like, he started teaching me things like the rule of 72, like what a Roth IRA is, what an IRA is, what the different markets are. He just gave me a little bit at a time, right? And so over time, like that money started to snowball a little bit, right? This is leading up into the GFC, and it was doing pretty well. And after I graduated, I wanted to put. I realized like I started getting the statements from Primerica, and I know the value was going down. So I was like, look, I need to put more money in. And so I'm trying to put more money into these mutual funds and like buy more, because that's what he told me, just like continually buy more. And so I was just doing what he told me. And then they're like, no, you can't. The fund is closed.
Mm.
And so I called Primerica, was like, what's a closed fund? Why is it closed? Why can't
Close
I,
ended.
like, I
Yeah.
don't understand it. And the customer service agent was just like, look, you need to talk to your financial advisor. I was like, I don't have one. He doesn't work for you guys anymore. And I was like, can you guys just assign me a new one? And they said no. And I was like, well, what does it take for me to get a financial advisor? And then he was just like, well, you don't make enough money. And at the time, I was like, man, I'm making like $42,000 a year. It was more money than anyone in my family was making. So I was like, dude, like, what are you talking about? Like, I'm making a lot of money. And he kind of just like disregarded me. And so I was just like, fine, I got this fresh degree from the United States Naval Academy. I got a degree in applied mathematics. I can figure it out, right? I can learn anything. And so I asked him, it's like, well, what do financial advisors learn? Or like, what do they read? I'll read that and teach myself then.
Hmm.
And the guy was just like, start with your prospectus. So I read the prospectus, and that thing was just full of jargon, man. Like I had to like, it wasn't Google at the time. I think it was like Ask Jeeves or something of that sort, right? Because Google was just, it wasn't like the powerhouse what it is. And so I would like look up terms or go into the dictionary, look up terms. It took me a long time, but I got through it. And it sort of created this fire in me, like I'm gonna learn this stuff better and better and better. And I mean, it was just like little things after a while. And then I learned the power, like I needed to apply to med school, but med school is a very expensive process. So I realized I had to save money. So I had to come up with a plan to save money. Then that taught me how to budget, right? And so it's just like one of those things after another, right? So then I was saving without a purpose, and then I became an oversaver, and then I had to learn how to not save so much and have fun, because I had never had money before and known how to like truly have a healthy relationship with it. So over time, it just after a while, I just started like learning something else, and I put that in the back of my mind. Then learn something else, put that in the back of my mind, and so I just gathered like eventually this like range of things that I knew about, whether it was taxes or mortgages or whatever. And then the pandemic hit, right? So we fast forward 15 years, then the pandemic hits, roughly 13 years, and the pandemic hits, and I'm watching people lose their jobs, can't afford. And I think there was some news articles that came out that said, hey, most Americans can't afford a $400 emergency. And I'm like, damn, like that's kind of tough, man. Like, and I here I was like my surgeries, I really wasn't doing many because of the pandemic. And I was like, man, I just want to help people. I got to figure out how to help people. And my brother challenged me to take whatever was in my head and just put it all out there so that other people can read and learn from that. And so I just launched that blog. And I just wrote everything I could, and that was directly from my head. I wrote all the topics down. I wrote all the articles. It turns out I was like a couple months deep on articles directly from my head without having to research anything. I just wrote everything I could. And then I got some feedback, and then I got some more feedback, and that feedback was positive. So then I had more confidence to keep going. So then originally I was going to be anonymous on Twitter, and then someone broke my anonymity. And so I was like, okay.
You got doxxed?
Say it again?
You got doxxed?
Yeah, I got doxxed by a doctor. And that particular doctor runs White Coat Investor, and he doxed me. And so when he did that, I just sort of had to just reveal who I was, and that's when I put the video and stuff like that up. I was like, look, I'm just trying to help people. And from then I was just like, well, I'm just going to be me. All right, because I don't need to be a brand. I just need to be me. And if people like it or they don't, no matter what, I'm just trying to put the information out there. So then I just started following people. And then as I learned, and because I can learn from a bunch of different people, sometimes people on Twitter contradict things that other people I know who know the topic very well. And I've learned it from them. So then I will ask a question like, hey, that's not what I learned. What am I missing? Because I come from the position that maybe I'm wrong. So teach me, right? Teach me the right way, or give me the source so that I can teach myself. But that's basically how we got here, man.
Yeah. I found your tweets. Twitter actually recommended you to me just because of the number of people that I follow in the finance space. So you've found your way even into my feed without having ever connected before. Your content is compelling. I think there's some conversations that you've been a part of there that have stoked a little controversy and maybe created debates on the wrong subject. The one I can think of is there was a conversation around what someone was calling the 4% rule, and it ended up becoming a debate over the semantics of whether it was a rule or a finding. And maybe you can tell us a little bit about that one.
Yeah, so one of my best friends, Jamie Hopkins, is quote unquote an expert in retirement planning, right? Like he's written several books. He is like an academic. He's published so much stuff on this, and he knows that that sort of literature and the evidence behind it like the back of his hand. I remember when I first said the 4% rule, he's like, dude, it's not a rule. It was a finding, right? And that finding was all academic, right? Like that was an arbitrary number that they tested, right? And it worked over time. Even the quote unquote author of the 4% rule actually has said that 4% may not be the correct thing, right? And so every time I'm constantly putting that meme up of my friend, because I'm like, hey, it's not actually a rule. What I'm trying to get people to realize is there's different withdrawal rates that you can use. And the other little caveat is I know that there's data out there that suggests that people don't know what to do with the money that they're pulling out. So they end up reinvesting it, right? So their withdrawal rate, because they've had this, people tend to be over savers. Not that a lot of people think everyone's overspending, but sometimes in retirement, people have over saved, right? And so if you're saving too much and you're not knowing what to do with that withdrawal, and all you end up doing is putting it back in, then that means you didn't need 4%. It's not a rule. And so a lot of the fire folks love to suggest that, hey, you have to calculate these numbers based on 4%. Hey, I thought it was a rule at first. I used to calculate those numbers too, like, oh, this is what you have to do, right? And it's just not a thing. It's not a finance doesn't have a lot of hard set in fact stone things. Like people try and say, oh, you only have to invest in index funds. No, that's not true. There's a bunch of stuff you can invest in.
Mm-hmm.
There are real estate people who are wealthy who have zero desire to invest in the stock market.
Right. They're all in real estate.
They're all in real estate,
Mm-hmm.
right? And they do just fine. They have a retirement, right? So while we tell people that, we tend to assume, and the world tends to assume, that everyone is average. And I hate that.
Explain why you hate that a little bit more.
Well, because how do I know you're average, right? I didn't take 1 second to talk to you. I judged you and said, oh, you're average, right? And that's what people do. Like, telling someone that all they need is index funds, you don't know what their motivations are.
Mm-hmm.
You don't know what their time frames are, right? Granted, if you're 6 years old, 7 years old, yeah, index funds will work perfectly for you, right? Because you have this long time horizon. But telling a doctor who is 35 years of age, or 38 years of age, 39, who just became a surgeon, when surgeons end up having ergonomic issues, so they some of them end up with low back pain, neck pain, carpal tunnel, and their profession tends to wear their body down over time. What if they don't want to be a surgeon for 30 years to allow index funds to work?
Mm-hmm.
Right? What if they need to speed up their clock just a little bit to give them some relief, to allow them to move on from doing surgery, right? Then they need to move a little bit further out on the risk curve. And I'm saying things like risk curve, those aren't the way that normal people talk about. They need to go look at other investments, right? Not just index funds. They need to add things in there. Because what if we have a 10-year period of the stock market that just so happens to coincide with the middle of them working, right? Their peak earning years, and the stock market doesn't do well,
mm-hmm.
right? Because we've seen that. That's happened in the past. No one ever likes to talk about it, but that's happened. And so if I only had 30 years longevity as a surgeon and I lost 10 years of it, where my retirement portfolio got cut in half for 10 years, well, what am I supposed to do? Am I supposed to keep working past the years I originally started? There's people who die while operating because they had to work for so long just to provide a retirement for themselves.
Mm.
And they never got a chance to retire. I don't want to be that person.
And it seems to me that you would love for lots of people not to be that person either.
Agreed. Right? Because life's too freaking short. My mom died at 49 years of age. Right? That's 11 years older than me currently. 49. That's way too young, man.
Right. Right. Sorry to hear that. So on the topic of Twitter in general, do you have some examples of where people can easily be misled that you found that the insights you can provide have been helpful?
Yeah, I mean, I get a lot of private messages saying, and this is from retail investors. This is from sometimes financial advisors, like, hey man, thanks for that conversation. I managed to find X, Y, and Z thing based upon something you said,
mm-hmm.
right? Or a question that you asked. A lot of times I ask the questions, but if you notice, I'm listening. I'm not going back and forth with people a lot because there's people who are way smarter than me on Twitter who are experts on these things, and then they talk, right? So yeah, I may ask the question and get the question, like the conversation started, but a lot of times if it helps change someone's course, like there are people who went and took the Series 65 because I was talking about, hey, taking a Series 65 actually qualifies you to be an accredited investor if you're interested in those things, right?
Right.
If you can pass it. I mean, those are little loopholes and stuff that I think about. Like, those are things, talking about crypto assets and different things, those are things that people And I have no problem questioning it, right? And all it does is just provide a different viewpoint. I don't work in finance. I'm on the outside looking in. I'm just a random guy on the internet talking. That's it.
Well, as we're all pretty much at home, and in many cases, many of us have to rely on the internet or our own resources to find good information. The real question is, how do we avoid traps? How do you discover and find that you're heading down the wrong path? You make this really important claim that not everybody should access just the average returns for the remainder of their working career. Sometimes you'll need access to funds a little bit sooner than that, and maybe your tolerance for risk is higher. How does one avoid the types of scams and traps that exist out there?
Well, so first off, anybody who works in finance knows that the really good investment funds or opportunities aren't advertised on Facebook. They aren't advertised on Twitter. They aren't advertised on any platform that you're just randomly. It's not going to be on a TV show. Those things tend to occur by word of mouth,
Mm-hmm.
right? A
Sure.
friend of a friend wants you, or your friend has access and knows a guy that gets you into the meeting, or a gal that gets you into a meeting. It's not going to be advertised, right? That's just not how those things work. Yet we have bloggers and financial influencers like pushing these opportunities to go on these crowdsource programs, to go on these syndicated things, to talk about these potential returns, and it entices people, right? They're chasing a number as opposed to using their own brain and saying, hey, guess what? This doesn't make sense. This person's guaranteeing me a return. That shouldn't be the case.
Mm-hmm.
They're saying that there's no risk here. That shouldn't be the case, right? I mean, think about it. There's insurance salesmen on social media who are pitching strategies for like whole life insurance and private placement insurance as a thing to beat the stock market. And there are people who believe that because they don't know anything else,
Mm-hmm.
right? Those are things that I'm trying to like call out and just be like, hey man, this is a red flag. Like, you're being misleading here. You can't say those things.
Yeah, I think having that conversation enough times helps it become more pervasive and more commonplace for people to understand. The reality for many people is that finance in general is complex. You mentioned earlier that you came out of high school with no real financial literacy, and I think we're undereducated in general in America at that age on finance. It was the same thing for me too, coming out of high school. There was no real deep dive into how personal finance works, let alone investing or trading or building wealth. So I guess the real question is it useful to have enough of these conversations enough times to where we've reached enough people that they're armed with their own decision making? Or do you think there's still room for the financial advice category there?
Financial advice is never going to go away, right? Because as you get more money, you're likely to outsource things,
Sure.
right? Which the financial planning and financial advisors have figured that out very well. There's going to be a subset of people who have so much money that they don't want to do meaningless tasks like manage a budget or manage their own investments because they want to go do fun stuff, right? Because that's not fun for people. It's fun for me. I have fun looking at this stuff. Other people don't, but I'm a weirdo, right? With that being said, eventually we have to get to a place where everyone has the same similar type of financial knowledge or baseline, or we raise the bar on what's the floor of what financial knowledge or financial literacy is supposed to look like, right? If we all have a generalized baseline knowledge, think about how well the market is going to behave, right? If we all know what the things we're supposed to be doing, the average things, excuse me, the average things, drinking kombucha, man, don't do it. Um, the average things that we're supposed to be doing, meaning if everyone's like, hey, at a minimum, I'm supposed to save a certain percentage, just don't take as much risk, but do a 60-40 portfolio with index funds and a bond fund. I mean, that behavior sort of raises the bar in the competition of what the market's having to sort of beat, right? And that's better for everybody.
So how does one then make a decision for themselves using all the resources that are available on Twitter and the internet and through their financial advisor, and still arm themselves in a way that doesn't lead them down a path of too much danger. I mean, crypto is certainly a path that some people are exploring because it's volatile. It has some promise of high return relative to other asset classes, and yet it has considerably more risk than these other asset classes too. I think the trouble here is carefully traversing all those different options and still ending up on the path that you wanted to end up on in the first place.
Well, why you have to look at why people even went down the crypto path to start with, because they felt locked out of the traditional financial system. Like if people didn't feel locked out of the traditional financial system and didn't feel like there was a barrier there to starting a retirement account, to knowing how to invest, right? Crypto was wide open. Hey, here's my Robinhood account. Here's my Cash App account. Here's Coinbase, right? Let me just get started. I just buy a couple coins and hopefully they go up, right?
Mm-hmm.
It's all speculative. Now, to people who are working in finance daily, yeah, they see the behavior like, man, that doesn't make sense. But at the same time, if people are afraid of the existing financial structure, why would they run towards the thing they're afraid of when this new thing was being wide open and opened arms towards them, right? They may not see it as risky. They may see the thing that if they're taught, like, don't trust the bank, then why would they go over there and try and do something that looks like a bank when crypto doesn't?
Yeah.
So it's all perspective, right? And if you think about it this way, if finance wasn't so closed off, and people had a trusting relationship with the existing financial system, they would have never turned to crypto in the first place. Crypto would have never been invented, right? Bitcoin would have never had a reason to be invented if people had trust in the system.
It's a fair point. Is that to say then that we should lean into that further, especially with the circumstances we're faced with today? Unstable banks, we have the SVB crisis and now Credit Suisse. What's your take on crypto being a viable future path?
I think crypto still hasn't found its use case, right? If there's ever a moment for crypto to prove itself, it's this freaking moment right now. Right? With these banks going down, and there still hasn't been a cryptocurrency that proved themselves. The other thing is, you can't have this many coins, like these many assets, crypto assets, right, without a more dominant one. You can say Bitcoin is dominant, but Bitcoin's been around the longest, right? So it's kind of at the top of the pyramid, right? But with so many choices out there, it dilutes the potential of any one solution being the thing that we need. And here's the reality: there's no magic bullet, right? That journey's over, right? We know it's not an inflation head. We know it sort of acts like a sort of startup tech company, and that's how they trade. And it's all speculative. It's not linked to anything, which is fine, but it's all speculative. So at this point, if crypto was going to prove itself, it needs to prove itself now. The thing that I'm more interested in is if stable coins can replace something like a Silicon Valley bank. But the reality is banks have an inherent amount of leverage built into it. If you're talking about stable coins, that's supposed to be backed 1-to-1, right? So I think a stable coin has to come out of this and be the winner, not Bitcoin, not Ethereum, a stable coin that the system and not everybody, but majority, like let's say 60% of people trust, and that's the thing that has to survive. But if that doesn't happen, then crypto's going bye-bye.
Would it make sense for a stablecoin to even be based on a fiat currency that's subjected to modern monetary policy and the types of shaky ground that's on right now? Or should...
I think at the end of the day, you have to have it based on monetary policy, right? Because policy, unfortunately, governs everything that we do. If you don't have it based on monetary policy, people are going to pervert the system. Like, you have to build rules into it, and it has to exist into the existing monetary system. The best thing is if all the nations came together and said, hey, you know what? Crypto's not going away. Let's agree upon a standard stable coin, a standard currency across that backs literally every currency in the world. The problem is there's no incentive for people to do that. because someone always wants a leg up.
Hmm. So do you have general feedback on where crypto serves a role for you right now?
It doesn't.
No.
It's a gambling tool, man. And even then, I haven't bought crypto. Man, I haven't bought any crypto in 2 years.
You just avoided the market.
Yeah, I mean, I haven't sold any. I just don't pay attention to it.
Hmm.
Right? Like I still like Cardano, and I still own a bunch of Cardano, but I don't expect it to go anywhere. It was all money that I'm okay losing
Sure.
if it goes to zero. If it doesn't go to zero, cool. I'm probably not going to sell it. I just kind of like it. I like the mission.
So maybe you can give us a little more insight into the types of paths you're taking for yourself in order to ensure your retirement.
Man, it's something I go through every day. Like, I always try and like make 5 year plans, 10 year plans. Where do I want to be? But there's so many different things, right? The reality is I realize there's certain aspects of investing that's not for me, and I've done all my research on it. Like, you're not going to catch me being this super fabulous options trader, because you want to know why? There's too many variables for me to track, and I don't have enough time in a day.
Hmm.
Um, Real estate is great. Every doctor loves real estate. Why? Because theoretically it could be passive if you set it up correctly, but it requires a lot of active component. The best real estate is the ones that are deals where you're value adding, but it's everyone's competing for those same deals. And then leverage is a problem. And then having the capital up front to be able to get the properties that you need and put in the time and having a team is very tough. So then you ask yourself, well, if I want to just be hands off, well, do I become an LP in someone's fund? Well, what's one of the number one professions that get embezzled? Doctors, right? Partly because they get pitched, and I get pitched stuff all the time. I had to go to a default answer of no, right? And then let me look into it, because of the fact of a lot of stuff that people are pitching on. Again, the really, really good funds don't need to advertise or pitch anyone that they don't want. And they can be very selective. Like, I'm never getting into Sequoia's venture capital fund. No individual is. That's just a reality. Or I can say, hey, let me do the startup thing. But the reality is that works off of power law. You might get lucky in the first 50, but if you're not up to 200-300 investments, you're not getting lucky. And then everyone's playing that same game now, right? And because of that, returns, I believe, are going to go down, because there's more people in the venture capital ecosystem than there was before. And in angel investing, everyone wants to be an angel investor. And then there's the option of, hey, do you start your own business? Well, 90% of businesses fail. Well, whatever you're investing in, you don't want it to necessarily be another job, right? Because you got to spend some time with your family. I love my family. I love my kids. I love my wife. I want to spend time with them. So what I'm doing personally, I'm looking, right? I'm trying to keep as much on the sideline as I can, so that when I find the right thing that works for me,
Mm-hmm.
I buy that thing, and then I refine it, and then I do it again. But I haven't found what it is yet.
Is it likely to be a business then?
I am really enamored with the concept of laundromats.
Mm.
So it probably will be a business, but not every business is good, right? Is going to be the correct business for me to be able to continue being a surgeon, right, and have a business.
Mm-hmm.
So I just sort of have to wait, and that time might never come. Until then, majority of my money goes to index funds, right? And I also buy microcaps,
Why microcaps?
because that's where institutions can't go, right?
Mm.
So it's less efficient, and there's going to be more of an opportunity for me to find undervalued things that will likely revert back to mean or go up.
So you're looking for microcaps that have been sold off to a considerable level. They're essentially oversold.
Yep.
Got it.
So basically, I look for fundamental value screens, right? Like, hey, because there's a whole the microcap universe is wide, right? So I have to look for things that like a company that is producing relatively great earnings, right, and revenue consistently and growing, even if it's a little year over year, while also at the same time having a healthy balance sheet and its book value being more than what it currently has in its market cap.
Mm-hmm. And are there red flags for the catalyst that cause the sell-offs, even if it's a microcap that has decent earnings or consistently good earnings for a long period of time? There's some reason that it sold off that gave you this mean reversion opportunity. Are there red flags that keep you from a microcap?
Yeah, man. If it's not like if it looks like it's going into bankruptcy, I'm cool, man. That's
I'll
just
take a
not me,
pass.
right? Because equity holders get wiped out in there, right?
Mm-hmm.
And I don't know enough about investing in corporate debt to be able to go on the bond side. So that's one thing. Two, if it's like if it's like a biotech that the drug that had before is no longer on patent and they don't have any prospects in the sort of pipeline, I tend to stay away from biotech completely
Mm-hmm.
because in my opinion that's more like gambling, and if I want to gamble I go to Vegas, um,
Or
and
crypto?
that way I can keep it contained, right? But I tend to avoid things of that sort. If the sell off is because of some bad news and it was more personnel related and the company got rid of the personnel, then I think it's overdone, right?
Mm.
Or if um, it's a sell off because not necessarily because the company did anything bad, but the sector was down, so everything got sold off, right? Because people were panicking. Then yeah, I tend to look at those situations, but it has to be a justified sell off. I mean, there's one company I'll mention, Cerence Technology was a small cap when I found it, and the pandemic pulled a lot of its earnings way too far forward. But I really like the company. I should have sold 50% of it, but I was under a Warren Buffett thing of just hold, be a long term investor, which is not the greatest way to be. But I watched that thing go crashing all the way down. I think I bought it at 40 something is my cost basis,
Mm-hmm.
and it went all the way down to $15 after going up I think over 200,
Mm-hmm.
right? And so that's a pretty emotional time. It didn't bother me at all. I was like, oh, that's funny. Okay, cool. Because I know that I wanted to hold that company for at least 10 years.
Are you still in it?
Because yeah, I'm still in it.
That's great.
I have zero plans to. I think it's like around 25 or 26 right now, but I have zero plans to sell.
Well, it might be
I'm
too
not going to
soon.
buy more because it takes up way too much. I'm already over allocated to that one portion of my portfolio. So
Got it. It might be too soon to say that the Warren Buffett approach is a bad idea then.
no, I mean the Warren Buffett approach. The one thing is I've read a lot of books, just like everybody else, but I can keep these consistent like themes in my head. One thing that everyone says, and Warren Buffett said the same thing, whether it's Peter Lynch or other people,
Mm-hmm.
they sold too soon,
It's usually the
right?
case. Yeah.
And typically you sell because you're being emotional and you're like, I should just sort of, I think this is too. So now what I tell myself is like, look, I'm not going to risk more than I'm not that, then I'm willing to go to zero. So I only risk what I'm willing to go to zero, and I'm going to wait. Like I'll wait a significant amount of time. And one of the things that Warren Buffett used to say and Ben Graham said is, you need a significant amount of time to actually tell and see how the investment's doing. So I set a 10-year clock on this, right?
Mm-hmm.
Because this company was a spinoff from Nuance Technology. And so like it needed time to sort of figure itself out.
Yep. That makes sense.
Unfortunately, everything in the tech sector got carried forward. And so it ended up in the mid cap 400 at one point. It dropped out, but its earnings got pulled too far forward.
Mm-hmm.
So
that's good feedback. Well, what is the future of taking your time in finance look like for you? What are you hoping to learn next?
Man, right now, I am just taking it all in. I mean, there's a lot of stuff I don't know, right? The one thing about the bank, I love banks. Just absolutely, I'm completely fascinated with them. The thing about this whole banking crisis recently,
Mm-hmm.
Which has completely fascinated me. At the same time, I realized, like, man, no one really talks about cash management strategies, right? It seems like kind of smart. Like in hindsight's 2020, you're like, man, why didn't all these people have multiple bank accounts if they had over 250,000 in cash at that bank, right? Or what's the sweep cash sweep accounts, right? Or how does money market funds work? These are questions that I I I don't think really asked myself. So those are things that I'm learning right now. Like, what are alternative ways to manage cash in the short term, right? Because we know that if you go to Treasury Direct to buy anything other than I bonds, it's very confusing, right? And not everywhere offers the ability to buy treasuries right off the bat. But treasuries aren't they're they're you can take a penalty on them if you redeem them too early, like and so being able to manage your cash and your strategy for that is very important. And I don't think 100% of financial advisors know how to do that either.
Hmm.
And I think that's something that to focus on. Like everyone talks crap about treasuries and all these different things, but like when you talk to people, they'll talk about high yield savings accounts, but no one ever says like, "Oh yeah, just put your money in a money market fund," right? No
They
one
didn't
talks
used
about.
to.
They used to a long time ago. You're absolutely correct.
Yeah. I mean, obviously it ebbs and way and flows depending on where interest rates are, and now they're popular again.
Yeah, I mean, at the same time, a lot of people don't even know how the yield on a high yield savings account is supposed to work, right? Um, and they don't realize like, hey, banks tend to turn up or turn down the interest in order to get more customers in, and then eventually that interest drops down, and that's how they sort of keep you. And then they figure there's enough friction there that you're unwilling to move.
Hmm.
But those are just things that I think about, and that's what I'm thinking about lately. A lot of stuff that I'm learning is sort of preparing for the future,
Hmm.
preparing for David 10 years from now, who has significantly more assets, and trying to figure out where to move them appropriately.
Yep. Yeah, we should all be invested in that. There's no question. Well, if anybody wants to get a hold of you online, aside from your Twitter handles, is there any place they can go?
Yeah, they can go to my blog at surgifi.com, or they can go to Substack, just search Surgifi, SURGIFI, on Substack, or they can send me an email at contact@surgifi.com.
Awesome. Well, thanks so much for spending some time with me here. These are awesome topics in general, and I could talk about them all night, but I don't want to take any more of your time. So appreciate you spending a little time away from robotic surgery with me, and good luck with the rest of your evening and the rest of your night.
Hey, thanks.
All right, take care, David.